Never run out of battery again with the INIU portable charger, the slimmest 10,000 milliamp hour power bank that keeps your devices charged on the go. Stay powered up wherever you go. Click the link in the video description to shop now on Amazon.
What's up, everyone? It's Quorra here, and welcome to today's video all about dividend stocks that have sunk 33% or more this year, but still look super promising for long-term growth. Imagine you're looking at your investment portfolio and you see three S&P 500 dividend payers down by a third or more already. But if you can snag them now, you could be setting yourself up for a lifetime of steady income. That's what I'm going to dive into today with three stocks that have turned in magnificent performances in the past and promise a promising future. First up, we've got United Parcel Service, or UPS, whose stock is down about 33% year to date. Now this one might seem like a red flag on the surface, but hear me out. With its recent yield of 7.8%, you'd be getting some serious income for that $5,000 investment. We're talking about around $390 in annual dividend payments. The real reason UPS shares are down is because online shopping isn't happening as much as it might. People are worried about rising prices and the impact of tariffs on job security. And let's not forget the big blow to their business from Amazon.com itself, which has gone on to become a major delivery service on its own. Now, I know what you're thinking: is this a stock worth investing in? The answer is maybe, but I think it can do well over time. E-commerce isn't a fleeting fad, and UPS has some other tricks up its sleeve. Their forward-looking price-to-earnings ratio is 11.3, which is way below their 5-year average of 15.8. Next up, we've got Target, or TGT, another familiar retailer with $107 billion in net sales last year and over 400,000 employees across the U.S. They're down about 35% year to date, partly due to a decision to abandon their diversity, equity, and inclusion policy, but also some supply chain issues that are fixable. Now Target's got its challenges, but I think this stock will pay off for long-term believers in the brand. With a recent dividend yield of 5.3% and share repurchases on top of that, it looks like you'd be getting an 8.02% total return, which is pretty sweet considering it's grown by around 8.8% annually over the past decade. Target's forward-looking P/E ratio is actually below its 5-year average, suggesting this stock might be undervalued right now. And if you're patient and believe in the brand's turnaround potential, I think that Dividend could be yours to keep for a lifetime. Last but not least, we've got Constellation Brands, or SDZ, down 40% year to date, which has put its dividend yield at 3.1%. Now, this one might seem like a lowball yield, but it's also a sign of the company's recent share buybacks and a total return to shareholders closer to 8%. Constellation Brands makes alcoholic beverages mainly in the US, Mexico, New Zealand, and Italy. They've got some big brands under their belt. Think Corona, Modelo, Robert Mondavi, High West, and Casa Noble. Now Constellation's stock is down sharply because drinking rates among young people have been declining in the US to some degree, as well as worries over tariffs and immigration impacting Hispanic consumers' spending power. But the company's not giving up. They're aiming to focus on their higher-end brands and cut costs to turn things around. And here's the thing: with a recent forward P/E ratio of 11.3 below its 5-year average of 18.2, this stock actually looks like it might be a good time to buy in. If people keep drinking beers and other adult beverages, and Constellation can adapt as needed to changing tastes and habits, then I think they could recover. So there you have it, 3 dividend stocks that are down but still look super promising for long-term growth. Take a closer look at any of these that interest you. Know that there's plenty more out there like them, and don't forget to check out the Quorra channel for all sorts of investment insights and advice. Thanks for watching.